Multi-leg spreads are often overlooked by most commodity traders, but in my experience, they are among the best spreads to trade. Unlike standard two-legged spreads, multi-leg spreads offer more favorable conditions for several reasons. Hello, I'm David, a financial analyst with over 30 years of experience specializing in currencies and commodities. In this first part of the video, I will introduce you to multi-leg spreads. Let's start with the basics. What are multi-leg spreads? Multi-leg spreads are simply spreads with more than two legs. These instruments provide traders with the opportunity to further reduce risk compared to traditional two-legged spreads, as they allow traders to better offset counter-seasonal fluctuations and take advantage of more intricate anomalies that arise within forward structures. Multi-leg spreads, therefore, enable speculation not only on the price of the underlying asset, but also on the internal configuration of the various contracts that make up the term structure. There are two types: butterfly spreads, which have 3 legs, and condor spreads, which have 4 legs. In this video, you will see both butterfly spreads and condor spreads, while in the second part, I will show you how to transform a 2-legged intermarket spread into a 4-legged condor spread to reduce risk and margin requirements. As mentioned, butterfly spreads consist of 3 legs, forming the body and wings of the butterfly. A butterfly spread combines a short-term bullish spread with a long-term bearish spread, or vice versa. This means that you buy 2 different deliveries and sell one of them twice. Butterfly spreads can also be classified into 2 categories: intramarket and intermarket. Generally, intramarket multi-leg spreads are used specifically to speculate on changes in the term structure of a commodity. To better understand this, let's look at how to construct a butterfly spread on corn. A bull spread on corn, long July 25, short September 25. A bear spread on corn, short September 25, long December 25. So, the butterfly spread consists of being long 1 contract of corn July 25, short 2 contracts of corn September 25, and long 1 contract of corn December 25. If you buy a butterfly spread, it is because you believe that mid-term futures prices will decline, while short-term and long-term futures yields will either rise or at least remain stable. If you sell it, the reasoning is the exact opposite. These fluctuations in the term structure align with the usual seasonal behavior of certain commodities and can occur in both contango and backwardation markets. So, a butterfly spread creates a differential between 2 correlated spreads, allowing the trader to profit from term structure changes rather than outright price movements. This type of spread is particularly popular as it significantly reduces margin requirements, and many traders perceive it as less risky. In the corn market, and grains in general, the term structure provides multiple opportunities to profit from price variations throughout the year. Due to the basis of grain markets and the fact that new supply enters the market only a few times a year, the term structure can change drastically depending on supply-demand imbalances and seasonal factors. Intermarket spreads involve the simultaneous execution of multiple futures positions designed to replicate the inputs and outputs of various real-world product transformations or to hedge the production process. The most well-known intermarket spreads include the soybean crush spread, cattle crush spread, and crack spread. If you would like a dedicated video on these spreads, let me know in the comments. If I receive enough requests, I will create one. Another type of multi-leg spread is the condor spread, which is very similar to the butterfly spread, with the key difference being that the condor has 2 central legs instead of just 1, like the butterfly. This way, a broader range of deliveries is covered. A condor spread consists of 4 legs within the same product group, and with consecutive quarterly expiries. A long condor spread involves buying 1 futures contract with the nearest expiry, selling 1 futures contract with the next expiry, selling another futures contract with the following expiry, buying 1 futures contract with the farthest expiry. Condor spreads are mainly used in crude oil and eurodollar markets, with contract maturities typically at 3, 6, 9, or 12 months. Let's look at an example of constructing a condor spread with eurodollar futures. EDZ25 minus EDH26 minus EDM26 plus EDU26. Like the butterfly spread, the condor spread can fluctuate significantly and is also one of the best ways to interpret different parts of the term structure. For instance, using the euro-dollar as an example, if you expect the yield curve to steepen in the short term rather than in the long term, you could buy a condor spread. Conversely, if you anticipate the curve flattening in the short term compared to the long term, you may consider selling a condor spread to generate a profit. Now, let's see the pros and cons. Pros: higher profit potential compared to outright futures positions. Intramarket spreads allow speculation on medium-term trends or a directional approach, while intermarket spreads enable profiting from hedging strategies. Ideal for leveraging market dynamics, such as crush spreads, crack spreads, or anomalies in the term structure. Between 2020 and 2022, when many traditional seasonal trends were disrupted, multi-leg spreads proved to be more reliable due to their structural characteristics. Lower margin requirements. Multi-leg spreads are generally considered less risky by brokers, resulting in lower margin requirements and higher return on investment. Greater protection against underlying volatility and market manipulation attempts, as they consist of multiple legs. Cons. More legs mean more futures contracts, leading to higher commissions and wider bid-ask spreads. Some brokers may not support complex spreads, requiring traders to manually leg into the position. Futures with longer expiries may suffer from low liquidity and wider bid-ask spreads. Analyzing term structure changes or calculating processing margins can be more challenging than simply analyzing price movements. Now let's move on to practice. Let's look at two examples with charts. The first is a soybean crush spread, specifically minus ZSQ25 plus ZMV25 plus ZLV25, constructed by selling the August 2025 soybean futures contract, buying the October 2025 soybean meal futures contract, and buying the October 2025 soybean oil futures contract, as shown in the chart. The bullish seasonality began in January and will end between May and June. The second example concerns a condor spread on crude oil, specifically CLM25 minus CLN25 minus CLQ25 plus CLU25, constructed by buying the June 2025 crude oil futures contract, selling the July 2025 contract, selling the August 2025 contract, and buying the September 2025 contract, as shown in the chart. As I mentioned, the contract expiries depend on the time span between the first and last contract. They are usually set at 3, 6, 9, and 12 months, but in this case they are 1, 2, 3, and 4 months apart. The bearish seasonality began in January and will end in April. I want to emphasize that I have not conducted any analysis, and therefore I have no information regarding the current state of these two spreads. In conclusion, multi-leg spreads, alongside market anomalies, play a key role in my commodity trading strategy. My approach is always to position myself where the odds are in my favor. Based on my experience, multi-leg spreads are the best type of spreads to trade. They require lower margins, offer greater stability, and align better with seasonal patterns. That's why every commodity trader should consider them. In the second part of this video, I will show you how to reduce risk and margin on an intermarket spread using multi-leg spreads. Don't miss it. It could make a real difference in your commodity trading. Thank you for watching. If you found this information useful, leave a like and subscribe to stay updated. Turn on notifications so you don't miss any future content. See you in the next video.